time is money, but I differ with that. Money lost can be earned back, but if we lose our time, we will not get it back. So I thank all of you for joining for this webinar on time, on a weekend. Thank you so much for all of you for joining on time. Good morning. We have clients as well as prospects in this webinar. So for those of you who are not knowing about Holistic Investment Planners, let me give you a small brief about our company. I'm Ramalingam, Director and Chief Financial Planner at Holistic Investment Planners. We are operating from Chennai, and we are in this business for the last 20 years. And we serve both resident as well as NRI clients. We serve clients in their different life stages, people who are single, just married, people who are about to retire, and people who have retired. Similarly, NRIs who are residents when they are becoming NRIs, and NRIs when they are becoming overseas citizens, and when they are returning. In different life stages, they face different challenges. We have addressed all those challenges in our financial plan. We have also received the Best Financial Advisor Award for South India from CNBC TV 18. So this is a quick background about ourselves. Benjamin Graham said, an investment in knowledge pays the best interest. That way, you all have made a wise decision to invest your time in this webinar. I appreciate all of you for joining this webinar by investing your time on a weekend. COVID-19 has impacted the entire world, our economy, our income, and our investments. 38% of steep fall in stock market in March 2020, and in a couple of months, even before economy could revive completely, the market has revived. So is it justifiable? Is it sustainable? It's a question we all have in our mind. So we need an answer. On the other side, fixed income instruments rates have come down. If someone is looking for regular income from safe investment avenues, we have very less options with low interest rate. So how can we manage that? So this COVID-19 has thrown a lot of challenges. So that is why we have organized this webinar, investing during and after COVID-19. To give maximum value for the time you are investing in this webinar, we have invited a special person. This person is basically an expert and who has 25 years of experience in this industry. He has served in different positions. He's the present managing director of Kotak Mahindra Asset Management Company. He has over 25 years of experience in capital markets and market-related investments. He has managed fixed income funds, equity funds, and real estate assets for local clients as well as global investors. In his previous assignments, Nilesh has held leadership roles with Axis Capital, ICICI Prudential AMC, and Franklin Templeton. Nilesh is the recipient of the inaugural Business Standard Fund Manager of the Year Award for debt in 2004. Nilesh is a gold medalist, chartered accountant, and a merit ranking cost accountant. His hobbies include reading and educating investors on financial planning. He has co-authored a book on financial planning called A Direct Take. He is also the present chairman of Association of Mutual Funds in India, AMFI, and he is also a member of Prime Minister's Economic Advisory Council. So definitely Nilesh will be adding good ROI to your time invested. Over to Nilesh.
Thank you, Ramalingam. Good morning to everyone. This is one of the most unprecedented events in our lifetime. There is no precedence for this. Normally, when there is a problem, you try to anchor it around your experience. But here, there is no experience. How? medical crisis, economic crisis, and financial crisis come together and impact economy and market. First and foremost, since this is medical crisis, it will require medical solution. Today, Indian markets, be it equity, be it fixed income, be it currency, are factoring in that somewhere vaccine will come through and somewhere people will learn how to live with the virus. The fatality rates are down. The 7-day moving average of infection is down from about 10 lakh cases. Now we are at 8 lakh 85,000 cases in active. So effectively, all this data is pointing to market that somewhere there will be a solution to this medical crisis, maybe towards end of this year, maybe towards beginning of next year, but we will see a concrete solution emerging which will allow people to resume normal economic activity. If this assumption is not met, obviously there will be correction. If this assumption is met with earlier success, obviously market will move forward. Number two, markets are functioning of flows in the short term and fundamentals in the long term. Now, from a flow point of view today, retail investors are buyers of equity. Mutual funds have met with redemptions in last 3 months, and hence they have been occasional sellers. But bearing those periods, they have been net buyer of equity throughout the year. FPIs also have been buyers of equity, especially in recent times. And while they have pulled out money in all emerging markets, which are our peers, in India, they have kept on pumping money. The insurance sector also has been a buyer. So it's a very, very unusual time where retail, HNI, insurance, mutual fund, FPIs, everyone turns a buyer in the market. And no wonder that's why we have seen a sharp jump from bottom at 7,500 Nifty in March 20 to 11,600 today. Flows undoubtedly have driven prices up, but these flows are also coming with the hope that fundamentals will improve. The data is talking about the past. June quarter GDP came down by 24%, but market is looking to the future. Auto sales were up 30% year on year. Petrol fuel sales is now almost touching Jan 20 level. GST collection is 4% higher than previous year. Power consumption is 4% higher than previous year. Daily tractor sales are highest compared to last year. All these pointers are giving confidence to market that worst seems to be behind us. Now number of active cases will come down. There will be medical solution. Slowly and steadily, people will learn how to live with virus and carry their day-to-day activities. The numbers in September started improving over previous year in many cases. October, November will be festival season. Durga Puja, Dasera, Diwali, Christmas buying, all will come into play, and the momentum which we saw in September will be carried forward in October and November. By then, vaccine will come through, medical solution will come through, and life will go back to normal. This is the hope which has pushed market to current level. Now, obviously, market is also pricing in longer term things. There are a couple of factors which will change India's growth orbit in the years to come if we execute it well, if we convert this crisis into opportunity. For example, Netherlands is a country where 2/3 of land is below sea water, and which is where we have seen so many windmills in Netherlands which is constantly trying to throw water out. Despite being such a small country, despite being below sea level for most of its length, Netherlands is a powerhouse in agriculture. They export $80 billion worth of agriculture goods every year. India is multiple times Netherlands. In fact, India is world's largest arable country. India is world's largest arable land. And despite that, we are not there in agriculture exports. We are not there in agriculture exports for a variety of reasons. As government, in order to protect farmer, ended up creating rules and regulations which actually ended up constraining them. Now, for the first time in last 70 years, government has come out with agriculture reform. This is like 1991 kind of movement in India's manufacturing economy, where liberalization and reforms unleashed Indian entrepreneurs. Indian farmers can benefit tremendously if this agriculture reforms gets executed on ground. From contract farming to supplying wherever they want to focusing on sustainable farming. There are multiple things going on in the farm sector which is likely to support growth of agriculture in the years to come. Agriculture is where India's 70% population is dependent upon, even though it gives just 15% of our GDP. If agriculture starts doing well, this large population benefits and boom, growth rate starts getting sustainable. The second advantage which is coming to India is global supply chain management disruption. In 1980, India and China were of similar size. Today, they are 5 times bigger than us. They became manufacturer to the world. Every single company wanted to set up their supply chain in China. China was producing goods at very, very effective cost. They were very efficient. And in that process, China ended up becoming manufacturer to the world. Now, countries are becoming suspicious of China. They are asking their companies to move out of China and relocate somewhere else. Japan, US, European Union are requesting their companies to move out of China. The entire world is salivating at this opportunity, and everyone is going out of their way to bring these companies into their country. Many of our peers have better infrastructure, better policies, more efficient workforce than us. But none of them has 136 crore consumer market. India is only country which has this kind of consumer market. If we can replace red tape with red carpet, if we can welcome these companies into India, then there will be change in the growth orbit of India. Let me give you a very small example how big this opportunity is. In India, a Korean company called Samsung came long before. It's India's largest consumer durable company. It makes in India and sells in India consumer durables like TV, fridge, AC, mobile phones. The turnover in India is about $12 billion. It's an unlisted company, so it's an estimate. Samsung went to Vietnam much later, but they were given a red carpet there. Samsung makes in Vietnam to sell all over the world. The turnover in Vietnam is $62 billion last year. Vietnam is 1/10 the size of India, and yet Samsung is 5 times bigger than what they are in India. One company contributes 28% of GDP to Vietnam. In fact, there are many items which we buy in India for branded Samsung, but they are actually made in Vietnam. Now, this is one company creating material impact onto a country. Imagine if India can attract tens of this kind of Samsungs, health and flourish in India like Vietnam did, can you imagine what will be the change in the growth orbit of India? Today, world is suspicious of China. No other country has 136 crore consumers. We can easily get lion shares out of these companies moving out of China. There was a company called Vestas which makes wind turbines. They came to India. They told Indian government that, look, we took 18 months to set up our factory in China. We would like to improve that in India. Government pulled all its socks together and Vestas started delivering wind turbines at the end of 15th month. Now this is an exception, not a rule, but it shows that if we want, we can compete against China. Like Vestas was given all the help and a red carpet, if we can do that with every other company which is moving out of China, we will be home. Our growth will change into double-digit trajectory for years to come if we can capture this opportunity. There are many such opportunities which are available to India. If we get our housing order, and agriculture reform and labor reform are suggesting that government is serious about pushing reforms and converting this crisis into opportunity. In India, this year monsoon rain has been good. Water level in reservoir is above historical average. We will see bumper Kharif crop and Rabi crop. More importantly, our FX reserves are touching almost $550 billion. There is drop in trade deficit with China from 23 billion in first 5 months to 12 billion. There is drop in gold import. Lower oil prices are also helping our economy. Put all these things together, the scars of lockdown are now behind us, and this recovery can sustain in the days to come. Now the question comes, how do we make money out of market? Haven't market run up from 7,500 to almost 12,000? Aren't market discounting all the positives? Is there an opportunity? Undoubtedly, yes. The easy money making which was there in the month of March is now behind us. I don't think so. We have easy money making opportunity left. In March, markets were undervalued. If you took the opportunity, well and good. But now markets are fairly valued. This is not the time to be overweight equity. This is the time to be equal weight equity. Put that much money in equity which you are comfortable in terms of risk taking. Now there are a couple of ways in which one can make money out of market. One is a regular investment and long-term investment. Today there is a lot of noise in social media about SIPs not delivering appropriate return. SIP is giving negative return. But let me put some data in front of you. In Jan 20, across majority of our equity funds, we were delivering double-digit SIP returns. 1 year, 3 year, 5 year, 7 year, 10 year. Most time periods, most of our funds were delivering double-digit returns. By March 20, numbers became horrible. 1 to 5 year returns became negative. 7 to 10 year returns came down by 50%. All equity funds SIP returns were in single digit positive or single to double digit negative. Obviously, this was horrible experience for investors. This is where social media started talking about stopping SIP returns being negative. People who got lured by that noise ended up redeeming or stopping their SIP. But people who listened to advisors like Ramalingam, people who had seen experience of 2000 and 2008 continued their SIP. From negative SIP returns in September, returns have come back to higher single digit. In many cases, it has crossed double digit. Returns are not as good as Jan yet, but they are substantially improved over March level. All SIP returns in a bear market will look poor or negative. The same SIP returns in a bull market will look fantastic. Key is to continue doing your SIP despite occasional setback in terms of negative return. So first request to all of you will be do your SIP unless there is financial emergency. Whenever there is poor or negative return, probably this is time to do SIP top up and put some more money at those attractive valuations in market. The second thing will be allocation. Today, markets are fairly valued, so it is time to be equal weight in equity. Tomorrow, markets could be expensive, then it's time to be underweight. Or if markets are cheap, then it is time to be overweight. Your allocation has to change in line with valuation of the market. Now, many people say, Nilesh bhai, it's so difficult to time the market. Of course, it is difficult to time the market, but you can't be accurate in terms of magnitude, but you can still be accurate in terms of direction, and that is good enough. We have a fund called Kotak Balance Advantage Fund. Its mandate is to invest 20 to 80% in equity looking at valuation of the market. When markets are expensive, we will put 20 to 40% in equity, trying to be underweight. When markets are fairly valued, we will put 40 to 60% in equity, kind of equal weight. And when markets are cheap, we will put 60 to 80% in equity, kind of overweight. In Jan 20, to be precise, 17 Jan, index was at 12,352. Our allocation became 39%. Now, with the benefit of hindsight, we should have put in 20% only, the bare minimum which was mandatory. But fair enough, directionally 39% was still underweight equity. In the last week of March, at 7,800 Nifty, we put 75% in equity. With the benefit of hindsight, we should have put 80%. But fair enough, 75% was close enough. Today, as we speak, we are at about 45% in equity, kind of neutral weight, equal weight. By doing this consistently over last 2 years, we have outperformed benchmark indices. Our NAV is at all-time high level. And in last 3 years, September 18, September 19, September 20, those 3 points when Nifty has more or less remained 11,000, this fund is up 17%. This is what asset allocation is all about. Buy when things are cheap, sell when they are expensive. So one strategy is to be a long-term investor with regular investment. Second strategy is to be a long-term investor with disciplined asset allocation. If you follow these 2 processes, you should be in a position to generate fairly good return on your portfolio. The second thing is related to fixed income. In the month of April, there was a lot of noise on fixed income funds. Franklin Templeton announced winding of 6 schemes. The social media created a noise as if all debt funds are in trouble. Investors were asked to redeem from debt funds, not just credit risk fund, but all debt funds. People even advised redeeming from equity fund in the month of April because of that winding up notice. Now, that noise is behind us. All of us did get unexpected redemptions because of Templeton episode, but we were able to liquidate our portfolio and pay back every single person. Because of that unexpected redemptions, we had to sell our papers at a higher yield. In the month of April, our credit risk fund delivered negative return of roughly about 3% in a month. May, June, July, August, September, things started normalizing. And today, if we look at credit risk funds return, it's almost 6% plus on a flat basis. What was lost in April was recovered over next few months and more. My request is that in fixed income space, you have to take a call whether you want credit risk or not. If you are taking credit risk, then you are going into credit risk fund where occasionally credit events will continue to happen. You have to take a 3-year view and stay invested in that fund. Credit events does not mean complete loss of money. You can always recover some money through enforcement of security. You will recover some money by recovering it from the issuer. So, subject to few credit events, which if you can take, then credit risk fund is appropriate. If you don't want to take credit risk, then there are many duration-based funds, maturity-based funds which are available. Banking and PSU debt fund, corporate bond fund, dynamic bond fund, gilt fund, short-term bond fund. Here portfolio is towards higher credit quality papers, and we try to make money by managing maturities of the fund. So today, if you can take credit risk, then go for credit risk fund. Coupon is good, carry is good over there. If not, then go for gilt fund, bond fund, dynamic bond fund, PSU bond fund, corporate bond fund that will help you generate return without assumption of too much credit risk. At the end of the day, pre-COVID, inside COVID or post-COVID, rules of managing money remains the same. Be optimistic. Tomorrow is always better than today. That's how you can make investment decision. Be a regular investor. You have to invest on a regular basis through the ups and downs of the market. Be a long-term investor, as overnight businesses don't get built. And most importantly, be a disciplined asset allocator. Buy when things are cheap, sell when they are expensive. If you follow these mantras, I'm sure you will be able to generate good return on your portfolio. With this, I will end my talk and open up for questions.